Tom, good morning to you.
Good morning.
I always like to call the jobs number the granddaddy of them all, because in my mind, for years, it has been the most important piece of economic data that we get from the government. Is that still the case? Is the jobs number important to the economic thesis?
I like to call it my most hated economic report.
And why? Why?
Because it's so noisy and messy. There's so much volatility. And I think people try to draw these broad, big, sweeping conclusions based on a single print. And I think if you try to do that today, I think you're going to be in for a world of hurt. Because there's going to be a lot of noise in this report because of the GM strike. I think hopefully as appreciated, although listening to some people, I don't think it is appreciated. You know, GM is worth at least $50,000 on this payroll report. And I say at least $50,000. It could be well north of $100,000 because GM obviously had all these sort of periphery companies that got sucked into it as well. So, you know, we'll see how it shakes out, but I wouldn't read too much into this single report. I think if you want to make a sort of a case for where are we from a labor backdrop perspective, then I think you just look at jobless claims. And what we know from jobless claims is that there's not a hint of stress in the labor backdrop.
All right, so, and that is high frequency or higher frequency data, right?
Yeah.
We get it every week. You kind of get a better picture of trends and everything. So is it fair to say that the employment picture, although it could show some real signs of slowing down, is not pointing to a recessionary threat anytime soon?
Yeah, I think people have to keep in mind, like it's not a hyperbole or a guess. You know, job growth has slowed down. But slowing down to, you know, we're averaging roughly 140,000 jobs thus far this year. That doesn't necessarily mean that sort of the next stop is, you know, 0, and the next stop after that is minus 100. I mean, we will get there at some point, obviously, but it doesn't have to happen in this sort of quick succession. You can sort of linger here. Which is exactly what we expect will happen. Again, in the context, again, these are not guesses. It's all in the context of we have a really tight labor market right now. You know, we've been fond of telling people, you know, we have 1.5 million more job openings than we do the number of unemployed in the United States, right? This is a stat that, or this is a fact that we've never seen in the history of the data.
And you're referring to the job opening,
openings, exactly.
labor turnover.
So labor markets are tight, and thus it's really easy to make the case that you'll see continued wage pressure, and that's the thing that can obviously help propel consumption.
Let's talk about you as an economist and how you reconcile some of this data. You say that there is no real stress out there that you see. Yet every time we kind of see some of these headlines with regard to manufacturing data, let's not even talk about abroad. Let's just talk right here in the U.S. Chicago PMI yesterday, certain ISM indicators, certain manufacturing gauges from regional Fed departments and regions. How do you, as an economist, take that data and then say, hey, things are not really that stressed?
Yeah, so what I would say is there are definitely some points of stress, and I think manufacturing is a sort of a great example of that. When we look at the sort of the broader backdrop, we feel pretty comfortable with where we are. But there's no question that manufacturing has been under pressure, and a lot of that obviously relates to trade. And what's very interesting is that you actually see this divergence in the soft data versus the hard data. So the soft data, things like ISM, sentiment-related measures, they have actually continued to perform pretty poorly, whereas the hard data have held up, you know, a bit better. In fact, interestingly enough, there's even a divergence within the soft data, right? So if you look at like ISM, ISM has obviously performed very poorly, but if you look at the regional PMIs, the Chicago report notwithstanding from yesterday, the regional PMIs have actually held up much better in ISM-adjusted terms. So, you know, even within the sentiment data, there's sort of a schism. And again, we know why that's the case. It's all related to trade for the most part. And GM obviously recently has added some stress points.
We've just got a few moments left here in the show. Take us through what exactly is going to be the most important thing that you look for today in the number for jobs.
You know, I think that it's going to be really hard to look at this report and be able to just cherry pick one or two key things, because the reality is that the GM report is going to be sort of littered throughout.